Hello everyone, welcome to the first of the IPO series webinar. In the first half about IPO allotments and the returns, we have Mr. Sandeep Baid who will be covering the topic, who is the co-founder of Multipie. In the second half, we will be having the topic what went wrong with the Paytm IPO. We will be having Mr. Mridul Jalan talking about the topic, and he is the co-founder of Senora Advisors. With this, I will request Mr. Sandeep Baid to take over and start the webinar.
Thanks, Sandeep. Hi, everyone. This is Sandeep, IIM-C 99 batch. What I'm going to cover is how to maximize listing gains from IPO with limited equity market risk of 1 week. Not for the purpose of this presentation, get into longer term hold versus sell strategies, but focus on the 1 week listing gains, which is available today for a fair number of IPOs. Often the allocation is very low or even nil in these IPOs. So it's very important to reduce the cost of applying, make it zero, so that whatever comes as an allotment is a bonus or a gain, which can be done simply by using ASBA to apply. By default, today's savings accounts are ASBA. If you have any doubts, check with your banker. The advantage of this is that the money does not leave your account till you actually get an allotment, which means you continue to earn interest on the amount because it remains in your savings bank account while you are waiting for the allotment, whether or not you get it. A typical IPO timeline would have a closing of offer on day 3, the last day, and a listing of IPO on day 11, which means there is a market risk of 8 to 9 days that you are taking. Yes, this market risk cannot be wished away, but it can be played smartly, as we will see in the following slides. Some steps to follow while applying for an IPO. You can check our blog on Multipie. On the app, we give info on which IPO to apply for and which not. You may also have your own other sources. You apply typically on the last day of the IPO because by then you would have a fair sense of demand and market views. It doesn't matter whether you apply on the first, second, or third day. Your chances of allotment are same. Make sure you use an ASBA account for applying for the IPO so that you do not lose any interest amount. And on the day of listing, you can sell the shares assuming you are looking for a simple fixed return for this period of investment, which is 8 days. You may also choose to hold some shares for a longer period, the ones you are bullish on, but that's very share to share specific. So we are not covering it today. We at Multipie, we had actually uploaded blogs on how to enhance your fixed income returns with limited market risk way back in January using IPOs as a strategy. These blogs are still there, time-stamped. So let's see what would have happened if somebody followed these blogs and used it to apply in the IPOs in 2021, which mind you was a bumper IPO year. Not all years can be so good. If you had applied in the HNI category, okay, what you would have got is allotments as below. Let's take one example. Indigo Paints was oversubscribed 263 times, massively. The listing gain was 109%. So let's take an example. If you had applied with, let's say, for the purpose of this example, let me take a very large amount, 2 crore 63 lakhs. The allotment you would have got would have been exactly 1 lakh. On that, you would have made a listing gain of 109%, which is you would have made a gain of 1,09,000 rupees, which on your initial investment of 2 crore 63 lakhs gives you a gain of 0.42%. Column D, 109 divided by 263%. That's the way in which this entire table flows. Let's look at the last one, NICA, where let's say you had assumed a large amount of 112 lakhs application, you would have got 1 lakh allocation because IPO was oversubscribed 112 times. On that 1 lakh, you would have made a listing gain of 1.1 lakhs, which on the total amount of 112 lakhs would have meant an overall absolute gain of 0.98 or almost 1%. So using this simply as a strategy, applying in IPOs that are looking good, selling on the day of listing, you could have actually boosted your fixed income return by 12.5%. Mind you, this was a record year. It will not be so good in all years. There's also a minus here, Brookfield India. There is some limited market risk. We had suggested people apply in this IPO, but it opened actually at a 6% listing loss, and people would have made a loss of 0.5% on the amount they had applied for, because the IPO was also oversubscribed 12 times, so people got lower allotments. Now, HNI category is any application above 2 lakhs. Up to 2 lakhs is retail category. Here it doesn't matter in an heavily oversubscribed IPO whether you are applying for 15,000 rupees, 1 lakh or 2 lakh, as long as you apply for the minimum lot of 15,000 rupees. The probability of receiving allotments is the last column, which as you can see is quite low because all the good IPOs are getting heavily oversubscribed. But still, if you can apply in a large number of names, family members, etc., you can increase your probability of allotment. You will not increase your probability of allotment by applying for 2 lakhs instead of 15,000, but certainly you can do so by applying in a larger number of names. A common question is, should I apply in retail category or HNI category? So let me give you a broad rule of thumb. If you want to apply for anything above 6-7 lakhs, go for HNI category. You will have a higher probability of allotment. Less than that, you can go for retail category. There are risks in this. SBI cards, March 2020, when the market went for a tailspin and COVID, listed at a loss. Brookfield also listed at a loss. So occasionally you will make a loss, but over time you should be making a positive gain. Some points to note. You can actually apply in very large amounts if the IPO is heavily oversubscribed on last day, because your value at risk is lower. You will anyway get a very low allotment, which could even be 1, 2 or 3% of the amount that you're applying for. Your value at risk is low. Home loan OD is a great tool for increasing the amount that you subscribe for. You can actually draw, let's say in my case, I have a home loan OD account, which normally I don't draw upon. But in these IPOs, I draw upon that home loan OD account. It gives me a large amount of liquidity, increases my ability to apply in larger amounts in these IPOs without any real cost, because while I'm paying interest on the home loan account, I'm also earning interest on my savings account, and thereby reducing my cost substantially. How we select or anybody should select IPOs, I think Mridul will touch upon that in the second half, is some factors: fundamentals, valuations versus peers, the quality of the anchor book, the gray market premium. Typically, if you are looking for listing gains, the gray market premium should be greater than equal to 20%, because these can be manipulated. Go for IPOs that are heavily oversubscribed, and speak to lead managers. If you can't speak to lead managers yourself, you can check out other sites or apps, including Multipie, which give this information. What is gray market premium? I'm sure most of us know, but still, it is the unofficial price at which shares are trading. Mind you, this can be manipulated, is volatile, so it's just only one of the indicators. There were a lot of IPOs we did not subscribe to. Sometimes we went right, sometimes we didn't go so right because we are conservative. So Paytm, Suryoday, we avoided all of them, but we also missed some good ones like Dudla Dairy and Exoro Tiles because they were very small. We avoided them, but in this bull market, even those made a gain. You know, in today's historically, it's seen that in a bull market, many companies IPO, but over time, over a few years, many of them cannot sustain it. They actually end up on a loss. So in today's market, most IPOs, we would be unable to recommend them to hold them for a longer period of time. But yes, the listing gains is where the accuracy can be higher. That is what we are focused on today. And how the Multipie community can help you. Finally, you can get answers to all your investing related questions on the app. We invite you to join the app, download it from Play Store, ask any question on investing, we will answer it. There are some other benefits also, which you can discover as you are on the app. Thank you, and feel free to ask any questions.
Thank you so much, sir. It was a very crisp and pointed. I request the audience to raise their hand if they have any questions. How much does one have to apply as an amount if applying in HNI section?
So as per SEBI norms, any application in excess of rupees 2 lakhs comes automatically under the HNI category. So you have two choices. You can choose to apply in retail, where typically 15,000 rupees is enough, or you can go for the HNI category. But our view is that if you have 3 to 4 lakhs to invest, actually go in the retail category. That tends to get less oversubscribed, and you will have a better probability of allotment there. But if the amount that you're investing, it's possible for you to apply for more than 6-7 lakh rupees, then you should go for the HNI category. We have done a math comparing over allotment or over subscription of various IPOs in retail versus HNI category, not running you through all the math, but the net result is that once you have more than 6-7 lakh rupees, you are better off in the HNI category.
We have one more question. HNI versus retail. What's the fundamental difference which makes them different in terms of probability of allotment in case of oversubscription?
Sure. So listen, HNI category or non-institutional investor category, that's the other name for it, is these are basically SEBI demarcations, right? So I can be a retail investor in one and an HNI investor in the second. First time I'm applying 15,000 rupees. So IPO number one, I'm retail. Next time I'm applying 10 lakh rupees, I'll be an HNI. So it is purely based on the amount of subscription that you make in the amount of application that you make in a given IPO. Point number one. Point number two is they are separate categories as per SEBI norms. So if you have applied under the retail category, what will be relevant for you is the number of times the IPO is oversubscribed in the retail category. And similarly, if you have applied in the HNI category, the basis for determining your allotment will be the number of times oversubscription in the HNI category. Typically, we are seeing in earlier IPOs that the HNI category is more heavily oversubscribed. Therefore, if you are applying at the exact margin, 2 lakh, 3 lakh rupees, like I just said earlier, do not go for the HNI category. You're better off in the retail category. But once you have 5-6 lakhs to invest, then you can go for the HNI category because the allotment is pro rata. The minimum lot that can be allotted to anybody is 15,000 rupees as per SEBI norms. So if you are able to apply for 60 lakh rupees, if the IPO is oversubscribed by 6 lakh rupees, if the IPO is oversubscribed by up to 40 times, you are guaranteed of your 15,000 rupees allotment. If the IPO is oversubscribed, let us say 100 times, then to be guaranteed an allotment in the HNI category, you need to actually apply 15,000 into 100, which is 15 lakhs. It's been painful for many of us. We have applied in so many IPOs, not got allotments in the best ones, but that is because of the way this oversubscription is working. Uh, uh, and, and your best bet is to apply in larger amounts if you are going for the HNI category. Retail category, applying in multiple names if you're going for the retail category.
Okay. Next question is, how do you choose to buy or not to buy in an IPO? What's your view on Star Health IPO?
Okay, so Star Health IPO is already over. It was oversubscribed by exactly 0.75 times. So, actually 0.79 times, it barely managed to scrape through. On the Multipie app, we had said that we are not subscribing to Star Health IPO because it's very expensive. How we choose which IPO to apply for is a mix of fundamental analysis and demand analysis. Fundamental analysis is peers, valuations about the company, the promoters, and demand is more short term. What is the demand? What is the gray market premium? What is the quality of anchor book? So it's a mix of the two, how we analyze a particular IPO. Uh, the net result is always shown on the Multipie app along with 3-4 slides of logic. So for example, right now, last week, we said Star Health we are not applying to, but Tega we are applying to. So that's the basis of the framework.
All right, sir. Do you recommend exiting within a week of the IPO listing?
Right. So it's frankly depends on IPO to IPO and from you as also as a person, right? So sometimes when we have a very strong view in an IPO, we say hold it for a longer term. But usually we like to play it safe and say, okay, we've got you a listing gain. Now you can choose to book it. So that's how we do it usually. And the logic for that is, as I said earlier, in a bull market, many companies are able to IPO, but when the market eventually turns, not many are able to sustain the initial listing price. So we do think that considering the quality of IPOs and the valuations that are coming today, majority, more than 50% of them will not be able to sustain these prices. Yes, some will go on to become stellar companies, but majority will not be able to sustain it. Therefore, I think you should hold on to an IPO only if you're very, very sure of the quality of the company and the valuations. Otherwise, you can actually choose to sell and book your gain. In the IPO market, there's such a frenzy that, as a joke, somebody was telling me that if he delists a company, if he delists his company and then again IPOs it, probably the valuation will double. That's the kind of IPO frenzy that is there today. It may not last forever. So yes, in a good number of companies, you should book your listing gains. One or two where you're convinced, you can hold on.
Can you please elaborate more on the pro rata allotment for HNIs?
Sure. So basically, it means that if you have applied for a certain amount, uh, right, and the IPO has been oversubscribed, you certainly cannot get app for the full amount. But let's take a very simplistic example. You have made an application for 100 rupees and the IPO has been oversubscribed in the HNI category 2 times. You will get an allotment of 50 rupees. If it is oversubscribed by 3 times, you will get an allotment of 33 rupees. It's pro rata. If the IPO is oversubscribed by 200 times, you may not get anything also. So because that's the way the math works. So it's pro rata. So the bigger the amount of your application, the greater your probability of getting a allotment. And there's no restriction. Minimum is 2 lakhs. There's no maximum upper cap as to how much you can apply.
So I will just play one sponsor. I request Mridul Jalan sir to talk about the Paytm IPO.
Thanks, Sandeep. Hello, everyone. As we have seen Sandeep Baid sir speaking about the process of IPO and looking at it, what I will do is I will look at the other side of it and try and explain how does the pricing happens, how does that back end of the process works, and how and what happened in the Paytm. So first let's understand how does the pricing of an IPO happens. When a promoter decides to go into the market and raise money from the public market investors, they appoint investment bankers. These investment bankers work very closely with the corporate promoter management to discuss a pricing and then go to the investor community, which is the FIIs and the DIs, the larger ones, and check if there's a demand at use valuations or not. In a traditional IPO, when I say a traditional IPO, I mean, as Sandeep sir showed a list of a lot of companies in 2021, most of them were traditional IPOs, and there the pricing becomes very easy because you have a peers, you have a growth parameter, and you can do a projections based on what the company has done and plans to. Whereas in the new tech IPO, the company is loss making and it's burning capital to grow. At that point of time, the valuation becomes very, very difficult, especially in the Indian investor community, because there are no track records. So what happened, and I'll run through 2 examples, whether it is the Paytm, I'll do rather with Paytm and not go back to Zomato. So probably in your Paytm, a similar thing would have happened. The bankers and the corporate worked together, decided on an amount and a valuation, and went back to see the demand. Now, typically, the Indian public market investors, including the FIs, would have used two benchmarks. One, which is the global peers in a fintech company based out of China, US, and stuff. And second is how the previous rounds have worked. Now, why does previous round working is important is please understand that the companies who are invested in the Paytms of the world have a huge track record of making money in unlisted companies and new tech companies. So most of the asset managers will assume that their decision making is right. And hence, between the last valuation and the company's performance between the last valuation to now would become a relative parameter. Secondly, in this era of new tech, there is a sense of a FOMO feeling. We as a retail and HNI investors also believe in the fact that ये company आ रही है IPO में इसमें लेना चाहिए. We don't even look at valuations, to be very honest. So a lot of people write checks even at a higher valuation because of the sense of participation. But what happens is that if the valuation is on the right side, according to the asset manager, his ability to write the check is much higher than otherwise. In particularly to Paytm, I'll discuss 2-3 points. One is the size. Paytm as an IPO was nearly more than actually is more than $2 billion. $2 billion of supply of a single stock where the valuation itself is very abstract meant that nobody had a view from a medium to long term perspective. So most of the people who would have got into the IPOs, especially on the HNI and retail category, would have gotten with the idea that like it happened in most of the IPOs of 2021, it will come with a listing gain, we will sell and we'll make some money and we are happy about it. While as for the institution investors, they realize this is the godfather of India tech. So we should be part of the IPO and hence you give a small allocation in the IPO and hence you don't really worry whether it is coming at a valuation of $21 billion or lower or higher. Because of this, what happened is the demand was more with the flow rather than the demand which was fundamentally driven. When the demand is with the flow and not fundamentally driven, then if the market scenario changes or the fundamental commentary has some impact, then it leads to a negative scenario, which is what happened with Paytm. While there were a lot of questions about why it was valued at X and not lower, I think given the valuations of the previous fundraisers and how the company did after that, the scope of a lower valuation was not there. And as I said, most of the investors were more of price takers rather than price deciders. Whereas in other IPOs like Policy Bazaar, Zomato, they there was a better valuation in my sense. There was enough valuation left on the table, and obviously market conditions helps. In case of Paytm, between the time of IPO and the time of listing, the market conditions had changed, and that for me was the bigger reason of the fall. Now look at the dynamics of demand and supply to understand what happened. Most of the people today in retail are nothing but they are like flippers. When I say flippers, I mean they want to buy in the IPO and sell on the first day. Now, when you have when you have so much of new demat accounts coming in from Chiroda, Upstock, Angel, and a lot of traditional brokers, these guys gets bombarded with the IPO recommendations to apply because these distributors get their fees for bringing the clients on board. Once that kind of a scenario happen, you have SBI and various ways to apply. You tend to apply in the IPO. I strongly believe that two-thirds of the money which gets applied in the HNI and retail category comes for the first day listing sale. So for a 17,000 crore IPO, where the retail HNI was around 35%, yeah. So that was a huge category. 3 से 4,000 crore का आपका first day selling था. Whereas the valuations was not attractive for the institution guys to come and buy it for that demand out. So there was a scenario of higher supply over demand, and that became a value at probably 1600 rupees, which is 30% discount to the IPO price, where the largest investors came and absorbed the stock over that 2-3 days. Stock market pricing is all about demand and supply. If you have, in case of Nika, the valuations were definitely attractive in terms of IPO price, and hence the investors who got under allocated, they came on the first day and bought a residual quantity because their blended cost still will be lower than the CMP, and that is what worked even in the favor of Jumeirah. Whereas in a traditional IPO, both the things typically doesn't happen, and hence the settlement price is not very high compared to the IPO price. Whereas in a smaller IPO like latent view, the investors don't even get the kind of portion they want. Hence, they come out on the open day and buy it. Now, another very important aspect which works in the IPO market is the gray market price. What is the gray market price? Gray market, while it's not officially accepted as a market, but it's a very common market in the IPO circle. Gray market is an OTC market where the demand supply decides a premium over the IPO price. How does the gray market pricing work? Two things. Gray market is not a regulated market, and hence I can have a wishful quantity or value to the one I want to buy, whereas I can also sell it if I think the IPO is coming at a wrong pricing, which cannot happen in the IPO because I can only apply to buy it. So gray market provides that equilibrium because they are buyers and sellers. Another aspect which is very important in case of gray market is the fact that gray market is the mechanism used by HNIs who take funding to apply in the IPO and the HNI segment and use gray market to hedge via their costing, which is why those guys typically gray market trades at a valuation which is IPO price plus cost of HNI funding. Whereas retail use to sell applications, there are lot many people in across India who don't even look at the company name. They just do an application and sell it in the gray market. And in the gray market, they sell their application. Jaipur and Calcutta are the big market for that. So IPO as a process in India, I think most of the people on the retail HNI side just do it with the objective to buy and then sell it off in a week, as Sandeep ji pointed out. The problem with that is you don't even know the company, and hence you will have no idea whether you should apply or not. So one parameter which we typically use other than reading the DRHP is one, the anchor list to look at the quality of the investors, and the second is on the day 3 of the IPO, what is the QIP which is going. Any IPO with a strong QIP which is 20-25 times typically will not open in a discount. In case of Paytm, coming back to what went wrong in Paytm, for me, the bigger problem was the size. And second, obviously, the valuation didn't left enough for the investors to come and buy the first day's supply. I think it is very noble for a banker or for a promoter to say that they don't understand the what kind of amount can come on the supply on the first day. If you don't leave enough on the table for an institution investor to come and buy the balanced quantity, the IPOs will have the fate which it happened in case of Paytm. Two IPOs which I always remember for understanding the valuation left on the table for institution investors. One is DMart and the other is HDFC Life. Both these corporates had a demand at much higher price than to the CMP at which they came out with the IPO, but they left enough money on the table because they understand that how you perform in the first week of the IPO defines your ability and perception among the investor community. Investors typically tend to hold on to the company where the stock price is doing well, and they become jittery if the stock price don't do well. That's the investor cycle, and you need to understand and manage it. Broadly, for me, IPO market in India is still a short-term investing mechanism from a retail HNI segment, and hence sizing, float, valuations is needed to support. And for HNI and individual investors, there are three parameters which we follow. One is reading DRHP to understand where that the company's strength comes from and try and value it on that basis. Second is from a demand side to understand the QIP part of it. And the third is for a listing game perspective, please look at where the gray market price is. Today, across WhatsApp group, we get the gray markets available. There are certain unregulated websites which gives you an idea of the gray market. Gray market is not an official way to trade. I'm not saying you guys to trade in it. All I'm saying is use that as to a track point to decide whether you want to apply or not. And as Sandeep ji pointed out through his Excel, you will not make money in all the IPOs. But if you try and choose your IPOs well, even if you lose in one or two, what you will make in others will help you to have a better yield across IPOs throughout the year. Please understand, as a retail, you cannot apply more than 15,000 rupees in any IPO, and hence you can't lose big or win big anyways. Regarding going for the HNI category, where with funding or without funding, for that you need to be highly convinced about the company and the probability of making money there, which is what is needed if you want to take a higher risk. So for us, it's about a process to understand the valuation, what the company is doing, the demand supply on the first day, which decides whether it will be a successful IPO or not. That was a brief observation from me. Happy to discuss more pointers based on question and answers.
Thank you so much, sir. That was very insightful. You shared a lot of observations. I have a few questions here. What do you feel about the attention Paytm has got? Like, did it pay any factor?
So, two parts. Paytm got an attention, but so did Zomato. Zomato had an equal split rather, I will say, had more negativity about it on the valuation compared to Paytm, with lot of financial stalwarts writing that at 75 it should be valued at 50 rupees and stuff, yet it listed 50% higher. The friend, the negative publicity does impact the price, but as I said, if you leave enough on the table for the institution investors to come and buy it on the first day, it doesn't impact the listing. What didn't work in favor of Paytm was a huge OFS. My point is that's where the bigger mistake did by the Paytm promoters and owners, that in India 2 billion IPOs, because it wanted to be the biggest IPO in India. When you try to do that as a risk, your supply may not get absorbed. Had it been a lower ticket size IPO, ये हालत नहीं होता. This is my first view. Most of the IPOs have OFS, and there are pointers raised about OFS. This IPO, more than 50% of the portion was OFS, and that is where the bigger mistake was. That just snowballed the size to a different level. Companies like Paytm need to come to capital market regularly to raise funds, and hence they need to maintain that investors make money when they raise capital.
When you compare this with Nykaa at having a 60 crore operating profit or opening profit and a huge market cap compared to that, what is your view or opinion on this?
So two, three things. First of all, credit to the Nykaa PR team. There was a lot of positivity created around Nykaa IPO through the promoter. Whereas in case of Paytm, The PR was more about the size and the OFS part of it. For me, PSS is the godfather of the fintech community in India. While I'm comparing him with with another great, Mr. Narayan Murthy, what Mr. Narayan Murthy did in Infosys to the IT world, VSS has done via Paytm to the tech world. It opened the doors of financial investors across the globe to come and invest in India. Instead of that personality move, which happened in Nika, it should have happened in Paytm also. Now, coming to the business part of it, please understand that Nika is an aggregator. When you're an aggregator, your first aim is to make a reach of your product to the consumer. Flipkart, Amazon, they are aggregators and they don't even talk about profitability. They talk about the size, the distribution. And Nika does the same thing. Hence, to value this company on profitability today is not the right way. It is to understand the growth in both in terms of the volume of the business you are doing and at the same time the reach you are creating. Is there an entry barrier? Is there a niche in the business? The answers to all of these in Nika was positive. And Nika had left enough on the table because of the revenue growth it is bringing for the investors. And the size of Nika IPO was not as big as a Paytm IPO. So the difference between performance of Nika and Paytm IPO, a lot of reasons include the PR around.
Next question is to do with the gray market. Actually, the question is, does it still exist despite KYC and compliance, some rules, etc.?
Gray market always exists and will continue to exist. It is not a recognized market. You cannot do a gray market settlement by taking the profit in your bank account or by paying out of bank account. You cannot offset your gray market profit and loss in your income tax return because it is not a recognized market. There's a difference between recognized market and a existing market. Gray market always existed. It was never recognized. It will never get recognized in India.
I'll just add one thing here.
Yeah.
The gray market premium is actually quite easy to manipulate. So never invest purely on the basis of gray market premium, particularly for the smaller IPOs.
Exactly.
They
The smaller size IPO, gray market. So which is why संदीप जी 500 करोड़ के नीचे का IPO का तो gray market होता ही नहीं. But yes, promoters do tend to manipulate
it
gray
can be
market.
manipulated. And anecdotally, there was a time when Paytm was also trading at an 8% gray market premium. So when gray market premiums are in the low range, 5-10%, actually there's a good probability that the stock will list at a discount because it's being manipulated.
Exactly. So which is why your thumb rule of 20% was very good point.
Yeah.
Question is, can you please explain the Aditya Birla Sun Life IPO with respect to the CMP?
So Aditya Birla IPO again, for me, the point was while it came out as an asset manager, there was no new excitement about the IPO compared to those already listed. In the asset management business, you have three companies which are listed, which is HDFC AMC, which is Nippon Asset, and the other is UTA. They all have different perceptions. HDFC is the best of the quality of the distributors coming from the HDFC group. Nippon is a re-rating story because it is not a Anil Ambani company and now it's more of a MNC promoter, whereas UTI is a traditional government asset management company. Aditya Birla Asset Management IPO is not a new feat to the market. It has nothing much to be excited or differentiated from the market, and hence you need to come at a big discount to your existing peers, which didn't happen in case of Aditya Birla IPO. While it came at a discount to the peers, but it was not an exciting case. Hence, it's just a process of listing. I don't think it was fair to expect any major listing gain or loss in this case. And we never looked at it seriously, frankly speaking. क्योंकि अगर मुझे asset management business देखना है for my portfolio or for my client's portfolio, I will look among the listed peers because I understand those dynamics a lot better than a new IPO. Which is why none of the insurance companies have made money after the first two IPOs of the insurance companies. Which is why Star is not going to make money on the listing day for investors, because while in the general insurance it's only the second company after ICICI Lombard, but it came out with an IPO because of the frenzy market at even a valuation even higher than the ICICI general IPO. You can't do that. Investors will not get excited about it. Valuation becomes a very important parameter other than business model. Just because you are a retail focus, you call yourself a franchise. ICICI Lombard is no lower franchise, rather it's a much superior franchise. You have to respect the market. That the fact that market is valuing ICICI Lombard at X valuation, you need to come with a lower valuation to that. And the same thing goes for Aditya Birla Sun Life. They had to come at a much lower valuation than this to make the investors excited.
Here, there's a question about India Hotels IPO issue coming up.
So
It's actually a rights issue, right? And the company has announced a right issue where currently the right entitlement is tradable. You can sell off your right entitlement in the market, or by a last day, which is I think around, I don't remember, but between December 5 and 15th, you have to apply for the balance amount and basically take your right shares. So that's what it is. It's not an IPO.
typically, rights issue is a good way to invest in a company if you are already holding it. But to buy a rights entitlement from the market doesn't make sense, because ultimately the price will get adjusted for the rights calculation and your equity gets diluted. The thumb rule is, if you like the company fundamentally, apply in the rights, take the shares. While I'm not officially recommending it, but I think Indian Hotels is a good rights buy.
I'll also share ICICI Direct. But if you have any more questions, please feel free to post in the QA. We look forward to more such IPO series so that it gets a good opportunity for us to discuss on more upcoming interesting IPOs.
Thank you so much. It was a pleasure.
Yeah, thank you, sir.
Thanks everyone.